Look, Amazon is trading at 2018 valuations. It essentially wiped out 4 years of gains, while revenue actually grew by 2 times in the same 4-year period. So this must definitely be an opportunity of our lifetime. What are you waiting for? Time to go all in. So this video is actually inspired by many of such similar commentaries that I've came across in my own personal capacity on a multitude of different social media platforms. So I'm not only pointing my arrow at Amazon, by the way. Don't be mistaken. I don't have anything against the company. It seems like a recurring theme across many other stocks as well. So giving you examples to back up my claim. Meta, which is formerly known as Facebook, is back at trading near 2016 levels. That's 6 years of gains being wiped out, while top line actually grew by 4 times. Disney, on the other hand, is trading near 2014 levels, and in the meantime, revenue doubled. Netflix is back at 2018 valuations, and revenue doubled as well in the same time period. So I think you get the drift. You can fit the same script, and you just mix and match the company name to its abysmal stock performances, and then look at the two revenue figures and say that fundamentals got better while Mr. Market is throwing a tantrum and the market is stupid. So if investing was that easy, I think everyone wouldn't be that envious of Warren Buffett. So I do know for sure that smashing the like button is easy though. It takes not more than a second or so. So every like is greatly appreciated. I know I do attract a certain type of audience on this YouTube platform, and most of you are probably pretty smart, if I can say so myself. So I'll make a bold speculation here that you guys are more inclined to favor picking individual companies to invest in your personal capacity. So how do I know? Maybe because I mostly talk about individual stock picks, but that's besides the point. So when you're bombarded with a whole host of investors trying to essentially pull you in many different directions, convincing you or pitching to you that, hey, X company is worth your capital because of X, Y, or Z, you might probably want to first ignore its historical valuations, but instead, really just have a laser focus and look at the company on a standalone basis. So there's this silent killer called the anchoring effect. It's a pretty serious condition if you were to actually ask me. So truth be told, I personally suffered some levels of anchoring bias in my own previous experience as well, not going to lie. So you decide whether you want to take my lesson into consideration or not. So there are a few fundamental truths of the stock market that we have to consistently remind ourselves of. 1. Markets tend to be forward-looking. 2. A stock that is down 60% can go down another 50%. It will just be down 80% from its all-time highs. 3. Investing psychology tends to swing to either extremes. Extreme optimism and extreme pessimism. Circling back to that Amazon example, if you keep the 3 principles at the back of your mind, then you will realize that it doesn't really matter whether Amazon was trading at $180 at its peak or $1,800 at its peak. Today, the market is valuing it via the stock voting system called the stock market at $85 a share. If you're happy with the current valuation, go out into the open market and buy as many shares as you want. Nobody's stopping you. So if you think current valuations are not really justified, then just wait a little bit longer. Valuations might come down, it might not, but that's ultimately up to you as an investor to decide. So Amazon can be down 90% from its all-time highs for all that matters. We are only concerned with the here and now, and the overall market expectations of how Amazon is going to perform in the following 12 to even 18 months. So we can sit here and stare at Amazon's stock chart all day long and lament that, oh, the 50% drawdown this year is not really warranted. The market is overreacting. Investors are being emotional. Investors are stupid. But you can't deny that if you actually did hell onto Amazon since the start of the year, you have lost 50% of your capital, even though it's unrealized. So there's probably a pretty convincing reason out there in the market as to why Amazon lost $1 trillion in valuations over the trailing 12 months. So you either buy the argument or you don't. So for investors that are trying to quote-unquote bargain hunt in this price range and try to pick up some of these names that are deeply battered down, just be sure that you are essentially betting against the current market consensus and you are betting against the current narratives that is put forth by many of these bear arguments and deem that many of these concerns around the company would probably not be long lasting. So like I always mention in many of my other videos, the only edge you have as a retail investor is probably something called time. So you can wait it out while others, specifically people on Wall Street, tend not to have such an advantage. So since I talked about 4 specific names at the start of this video, you probably can guess that, hey, Chee Keng is probably in the midst of doing some sort of due diligence in each of these company names. Hence, I have a peculiar interest behind those names. So I might be distilling some of my thought processes behind some of these companies mentioned on my Substack. So do feel free to subscribe to that if you're interested. So I did do a slight deep dive on Facebook and it's already up on my Substack. Link is in the description. So I think there is a certain level of pressure for producing quote-unquote quality content, whether is it on YouTube, on Substack, on Twitter for that matter. So I'll try to get over it, but if you appreciate what I'm doing, do just remember to help smash the like button, since most of what I do is practically free of charge. And smashing on the like button is free too. Oh, and one more thing. The global equities market haven't been too kind to investors in 2022. And I know many of you have been sitting on a boatload of cash on the sidelines to essentially wait for an opportunity to deploy them at attractive valuations. Currently, Moomoo Cash Plus is a new product offering that allows you to invest into instruments such as a money market fund. So there is no lock-in period, no redemption penalty, and requires very little capital compared to fixed deposit. But do note that both capital and returns are not guaranteed. That said, they are fairly liquid and probably gives you a much higher rate of return for parking the cash with them. So they invest in short-term government treasuries and maybe also institutional bonds. So Moomoo Cash Plus is currently also running an event campaign where you can get up to $143 in return rewards. So if you are interested, you can log into the Moomoo app, go to Funds, top banner, and click Claim Now. So select the funds based on your own preferred currency, whether is it Singapore dollars or US dollar. Click on the orange button to subscribe. Enter your 6-digit PIN, and then voila, you're done. So for those of you who have yet to have an account with Moomoo, new sign-up users can also get up to 1 free Apple stock and a $20 cashback if you deposit a minimum amount of $2,700 with terms and conditions that requires to be fulfilled. So for my US and Australian viewers, I didn't forget about you. Moomoo is also running aggressive reward campaigns, giving out free stocks as well. So just make sure to click on the correct link below. Thank you Moomoo for sponsoring this video. Now, I'll try to explain what expectations the market is currently trying to quote-unquote price in to the 4 names out here. And you make your own assessment on whether you think these are good opportunities or not. So firstly, let's talk about Amazon. For Amazon, it's true that valuations are back at 2018 levels, while revenue actually 2 times in the same period. So the word on the street now is that consumer spending in the United States is basically falling off a cliff, and savings rates, at least personal savings rates, are at an all-time low, which would have a direct hit on their retail segment, which is already burning a huge ton of cash. So their cloud segment, which is AWS, seems to be experiencing a slowdown since many corporations are preparing for a slow 2023. So this whole recessionary talks since the start of the year essentially became a self-fulfilling prophecy. So Amazon's capital allocation over the last 6 to 8 quarters has also proven to be substandard at best, and it shows in their numbers. Their free cash flow essentially evaporated due to their reinvestments into infrastructure and their fulfillment network, but overdid it due to the demand being pulled forward because of the pandemic in 2020. And this current unraveling process will be painful, especially if 2023 really turns out to be a very bad year for spending. So Amazon is feeling the heat from all sides, and the market is probably trying to price in the slowdown, even though nobody really knows how bad will things become. For Disney, they had a great run in 2021 because of the whole Disney Plus discussion and how they're going to take over Netflix, and they managed to grow their user base by a large extent, and you see fanciful graphs being plastered everywhere. This year, however, the narrative essentially flipped on itself. Investors suddenly care about profitability and not growth at all costs. At least in the streaming space per se, Netflix seems to be the only one, for now, that has figured out how to at least turn this business model profitable. So Disney, on the other hand, is currently cannibalizing their traditional network distribution with their own D2C, which is direct-to-consumer product offering via Disney+. So Disney theme parks are still fantastic. It's a business model that many companies would queue for. The theme parks are still in their recovery phase, so nothing much to worry on there. Two main issues with Disney now: management and streaming. For management, Bob Iger recently took over the helm again from Bob Chapek. And I don't really see this as a very bullish signal for the company, because the succession planning is well underwater and the company cannot rely on Bob Iger forever. Number two, streaming is still a big cash incinerator for Disney. I think for now, there isn't really a very clear roadmap on how they intend to steer this ship moving forward. So it's true that prior COVID, they were able to print around 10 billion in free cash flow. If you think that in the foreseeable future, they are able to normalize back to $10 billion, current valuations mean that they are only trading at 15 times price to free cash flow. So if you think that this Disney Plus cannibalization is going to fundamentally change the business and their ability to print cash moving forward, then you might want to crunch the numbers on your own. At Disney's current valuation, the market is clearly skeptical, and they're probably only expecting in the range of maybe 5 to 8 billion free cash flow max, suggesting around a 25 to 30 times free cash flow multiple, which isn't necessarily a screaming buy per se. So where did I get the numbers from? My ass, of course. Of course, it's based on my own projection, so you better do your own due diligence. Thirdly, on Netflix. For Netflix, I think the concerns are largely similar around churn and how much more they are able to reach closer to their TAM, which is total addressable market. So growth rates were also challenged in the last 3 quarters or so, and quote-unquote growth investors are essentially bailing out of the company, and they left for probably other more exciting and sexy stocks. So monetization becomes an issue as well, as they force every user to pay for a subscription, as they purge people from account sharing, and hence they are kickstarting the ad tier model, somewhat like Spotify, to essentially cater to this more price-sensitive audience, if I can put it that way. So I think the success of this model remains to be seen, because it has to flow into the numbers, but estimates are essentially discounting Netflix's growth from here on. And we are no longer talking about the sexy high 20 or 30 percentage points growth rates from here. Last but not least, Meta Platforms. They're essentially beaten down the most out of this lot, and rightfully so. Meta Platforms is essentially throwing money into a cash burning machine to cultivate this mythical creature called the metaverse. Nobody knows what to expect out of this project, and Mark Zuckerberg has been extremely poor in communicating the actual business plan to investors. So investors are essentially bailing out. Hence, great uncertainty causes great price fluctuations. So if you want to go even remotely close to Meta or Facebook, you'll need a fervent belief that Mark Zuckerberg is able to deliver and he actually cares about shareholders. I don't know about you, but personally, I do have a small exposure in Meta for now. So to conclude, there is always a mainstream reason on why stocks are quote-unquote cheap. So if everything goes well for the company, why do you think the stock will be down like 50, 60, 70 or even 80% in a year? So you just can't write it all off by saying that, oh, the market is stupid, or oh, people are emotional. There's always a convincing reason out there. So your job as an investor is to see through many of these narratives and conditions and make the independent judgment of whether you see or whether you think the companies that you are invested in are able to flip these problems on its head and come back stronger with higher profits, greater cash flows, and a brighter outlook. With that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!